If you had to build a portfolio that you wouldn't touch for the next 20 years, what would you own? Not the hottest stock, not the latest trend. Something durable, something diversified. Something designed to survive multiple market cycles. Good morning. Today we're looking at three ETFs that many long-term investors use as the backbone of their portfolios. Not because they're exciting, but because they're reliable. Let's start with the first one. One broad market ETF, the foundation of most long-term portfolios, is broad market exposure. This type of ETF tracks a large portion of the overall stock market. Instead of betting on one company or one sector, you own hundreds or even thousands of businesses. The advantage is simple: if the overall economy grows over time, your investment grows with it. Broad market ETFs capture innovation, productivity, and economic expansion without requiring constant stock picking. For most investors, this becomes the core holding. 2. International market ETF. Many investors focus heavily on their home market, but global diversification reduces risk. Different countries grow at different times. Different industries dominate different economies. An international ETF spreads your investment across markets outside your home country. That balance can help smooth long-term volatility. You're no longer dependent on one single economic environment. Instead, you participate in global growth. 3. Dividend or income ETF. The third piece adds a different dimension. Income. Dividend-focused ETFs invest in companies that consistently return cash to shareholders. That income can be reinvested for compounding or used later for retirement cash flow. Dividend-paying companies often have strong cash flow and established business models. They may not grow as fast as aggressive tech stocks, but they can add stability to a long-term portfolio. The midpoint truth: notice something about these three ETFs. They don't try to predict the future. They don't chase trends. They simply capture broad economic activity. Growth, global exposure, income. That balance builds durability. And durability is what allows compounding to work for decades. Why long-term holding matters: the biggest advantage of ETFs like these is simplicity. You don't need constant trading. You don't need to predict market timing. You build the structure and let time do the work. Because the longer capital stays invested, the more powerful compounding becomes. Short-term investors chase excitement. Long-term investors build systems. Final thought: if you were forced to hold only a few investments for the next 20 years, you wouldn't want something fragile. You'd want something broad, something diversified, something designed to last through multiple market cycles. And that's the real power of simple ETFs. They don't rely on perfect predictions. They rely on time. If this helps simplify how you think about long-term investing, subscribe, because here we focus on building portfolios designed to endure.